If you invest in biotech, you know the absolute terror, right? Waking up, checking your phone, and seeing your top stock just lost its flagship phase 3 clinical trial. It is literally the ultimate nightmare for retail investors, watching a pipeline darling just crash, burn, and wipe out your portfolio. But hey, stop what you're doing, because what just happened with Arcus Biosciences, it defies all standard market logic. Welcome to this explainer. Last week, I ran their Q1 2026 clinical and financial data through the ringer, and honestly, what I found shocked me. Right now, Arcus is like a ship that just lost its main engine, but somehow, the market thinks it's about to sail faster than ever. By the end of this explainer, you'll know exactly why Wall Street is actually doubling down on this stock, and you'll get a clear framework for how to view their upcoming catalysts. Just look at this completely surprising statistic. Despite that massive clinical setback we just talked about, analysts have actually maintained a highly bullish outlook. Recently, the average price target for Arcus was raised to $36.73 per share. Now, based on early June closing prices, that implies a massive 58% potential upside. So ask yourself, how on earth does a company lose its leading late-stage drug trial and still command that kind of market optimism, with a consensus buy rating across 12 different covering analysts? Let's figure it out. To make sense of it all, here's our roadmap for today's explainer. We'll start with their Q1 2026 financial picture, then look at the TIGIT trial setback, see how Gilead loosens its ties, examine the casdatifan pivot, and wrap up with future milestones in 2026. Let's dive right into Section 1, the Q1 2026 financial picture. So the financial picture for Arcus right now? It's definitely tightening up. Q1 2026 revenue came in at $17 million, which is a pretty noticeable drop from the $28 million they saw a year earlier. Now, it's really important to keep in mind that this revenue comes entirely from collaborations, primarily Gilead, rather than actual product sales. So it fluctuates based on when certain performance obligations are met. Meanwhile, their operating expenses, they remained stubbornly high at $151 million. Because of that heavy investment in late-stage oncology, their net loss actually widened to $128 million for the quarter, or about $1.02 per share. But here is the absolutely crucial point: survival. Despite that widening net loss, Arcus ended the quarter sitting on a massive safety net, $876 million in cash, cash equivalents, and marketable securities to be exact. Management firmly believes this runway is going to fund operations all the way into the second half of 2028. Even with all their aggressive clinical spending, they're targeting a $600 million cash balance by the end of 2026. This incredible financial flexibility is basically the armor that allows them to absorb bad news and just keep fighting. And they really needed that armor. Let's move to Section 2, the TIGIT trial setback. Arcus recently hit a huge clinical wall. They had to make the incredibly difficult decision to completely discontinue their Phase 3 STAR-121 trial. This trial was evaluating a combination of domvanalimab, which is an anti-TIGIT antibody, alongside zimberelimab and standard chemotherapy for patients with first-line metastatic non-small cell lung cancer. The hard truth in biotech is that the clinical data just doesn't lie. A pre-planned futility analysis basically showed that their experimental regimen simply did not improve overall survival when compared to the current standard of care, which is pembrolizumab plus chemotherapy. Because the treatment just couldn't beat what's already out there, Arcus pulled the plug on both the Phase 3 STAR-121 study and a related Phase 2 study called EDGE-Lung. It's a really tough blow, and honestly, it represents the deflation of the broader industry's once massive hopes for TIGIT inhibitors. So, how did their major partner react? That brings us to Section 3, Gilead loosens its ties. Following that trial disappointment, Gilead opted out of a 6th anniversary continuation payment. This means their broad option rights will expire in July 2026. Basically, Gilead surrendered its options on a handful of early-stage programs, specifically CCR6, CD89, and CD40L targets. But, and this is a big but, it brilliantly highlights the underlying value still sitting in Arcus's pipeline. Gilead actually retained their options for the clinical stage AXL inhibitor AB801, the anti-CD39 antibody AB102, and 2 preclinical assets, including an unnamed TNF small molecule inhibitor. So it's definitely a strategic retreat by Gilead, but by no means a complete abandonment. All right, let's look at how they're recovering in Section 4, the casdatifan pivot. With the whole TIGIT setback officially in the rearview mirror, Arcus is not just sitting around. They are aggressively pivoting toward their absolute brightest prospect in oncology right now. a drug called casdatifan, which is a HIF-2α inhibitor. Now, think of a HIF-2α inhibitor using a pretty simple analogy. It functions essentially like turning off a stress adaptation thermostat inside a tumor cell. You see, when oxygen is low, cancer cells use a specific protein, HIF-2α, to switch on their survival and growth programs. Casdatifan blocks this protein, effectively shutting down the tumor's ability to adapt and survive. This mechanism is incredibly important for treating clear cell renal cell carcinoma, which is a type of kidney cancer driven heavily by this exact biological pathway. And the early data here is exactly what has analysts so incredibly excited. In Arcus's phase 1/1b ARC-20 trial, casdatifan demonstrated a really stable median progression-free survival, or PFS, of 12.2 months across a pooled analysis. Now, we've got to be very careful here. The company strictly notes that cross-trial comparisons should be interpreted with a lot of caution just due to differences in study populations and designs. But just to put that into perspective, published data for a competing drug called belzutifan showed a PFS of 5.6 months in a separate late-line kidney cancer trial. So even with all those caveats, these numbers show exactly why Arcus believes casdatifan could genuinely be a best-in-class therapy. Arcus is doubling down hard on this momentum. To date, they've treated over 240 patients with casdatifan across all the cohorts of their ARC-20 study. Their number one priority right now is to establish this drug as the backbone standard of care for clear cell renal cell carcinoma. To make that happen, they are planning to initiate a brand new phase 3 trial in the first-line setting. And if you're watching this stock closely, get ready for a steady drumbeat of news because Arcus has planned at least 3 major data presentations for casdatifan throughout 2026. Finally, let's wrap things up with Section 5, Future Milestones in 2026. Beyond oncology, a steady stream of catalysts is coming down the pike for their brand new inflammation and immunology pipeline. In the third quarter of 2026, their first inflammation program candidate, AB102, which is an MRGPRX2 antagonist, is entering clinical trials. Then, by late 2026, as we discussed earlier, they aim to hit their target of roughly $600 million in cash reserves. Looking slightly farther out into early 2027, an oral TNF inhibitor is expected to enter the clinic, followed quickly by a CCR6 drug candidate in mid-2027. They are rapidly building out an autoimmune pipeline to act as a powerful second growth engine for the company. So, as we conclude this explainer, we return to the core paradox we started with. Yes, Arcus lost a major late-stage trial, but they also have nearly $1 billion in the bank to fund operations all the way through 2028. They have a newly prioritized oncology asset in casdatifan that's showing some highly promising early survival data in kidney cancer, and they've got this entirely new immunology pipeline waking up. You really have to ask yourself, in the highly volatile, risky world of biotech, is this massive cash cushion and rapid strategic pivot enough to make Arcus a winner in the long run? Is it enough to actually realize that 58% upside analysts are modeling? It's a fascinating balancing act for sure, and definitely one we're going to be watching incredibly closely as all this 2026 data rolls in.